Sense is run by a bunch of investment bankers, and their modus operandi.
Hello, I'm Fernando Luque, editor for Morningstar in Spain, and I'm joined today by Simon Surtees, a fixed income portfolio specialist at Stanfitch, part of BNY Mellon Asset Management. Simon, thank you for being here.
Thank you for having me. Good morning.
Simon, my first question is about the role of a bond fund in a portfolio. I know that it is technically not the best moment to invest in fixed income because we have very low yields, probably we will have an inflation problem, probably not today but in the next future. So what is your view of including a bond fund in a portfolio? I'm pretty sure that you have solid arguments to convince the investor to include fixed income in their portfolios.
Well, fixed income as an asset class, in most general terms, does provide a pretty certain level of income. So if income is important to you as an investor, then a bond fund, be it a government bond fund or a corporate bond fund or an emerging market debt fund, does have the ability to throw off an income stream. So that's an important reason for including a fixed income product in your portfolio of assets. You would typically also regard bonds as being an instrument that has a greater potential for capital preservation. They don't throw off the same levels of return in most instances that equity markets can do when equity markets are in a bull phase. But as a component of an investor's portfolio, I think bonds and bond funds should and will remain a very important component.
Yeah. Once the investor is convinced about including a bond fund in his or her portfolio, there are a few options. I mean, he or she can adopt a very diversified approach, including different type of bond funds in his or her portfolio. Or she or he can be very specific, for example, avoiding some segments of the markets. We will discuss the problem of the Eurozone. But what is your view on these two options, the diversified approach or the very niche approach?
I think the point about diversification is very important to make. Bonds are not a natural product for an individual to go and buy an individual holding in XYZ PLC's company bond. So as an investor, if you wish to have a diversified portfolio of bonds, really the only effective way to achieve that is going to be through a bond fund, where you have a number of investors, obviously with their money in the fund, holding a pool of bonds and other related securities. So diversification is a very important element of a fixed income portfolio, because the upside is you get your money back and you receive the interest when you expect it. The downside for bond investment, and what you should try to avoid at all times, is a default and the potential failure to recover either capital or due interest. So diversification is very, very important to have in a portfolio. Now, there is also within fixed income a whole host of different types of assets. You could have high yield, you could have investment grade corporate credit, you can have government bonds, you can have securitized and asset-backed securities, emerging market debt. And there are strategies. We have one in the BNY Mellon Euroland bond fund that looks at the totality of investment opportunities within the Eurozone and also beyond the Eurozone, and tries to seek the best returns for investors from the most sensible areas of bond security selection.
Yeah, and are there some segments more attractive than others? And I mean, if you look at the BNY Mellon Euroland portfolio, can you tell me that there is some segments more attractive than others in the fixed income area?
Segments and the areas of investment will change through time. If you go back to 2008, just before the Lehman's crisis and the credit crunch really started, then one of the areas that was not a good place to be was in corporate credit, whether it was high yield, whether it was investment grade, and particularly banking bonds, bank company bonds. This was, in 2008, very much a crisis within the banking community. And some of the bonds from 2008 and into early 2009 defaulted or moved very, very aggressively lower in price. So that was an area where you didn't want to be involved. In 2009, however, there was a very marked recovery in risk appetite, and the trick really for this multi-sector approach to investment is to see the opportunities as they arise. And this fund, the Euroland Bond Fund, moved quite aggressively into corporate credit in 2009. By the end of 2009, had upwards of 50% of its assets in corporate bonds, and that drove very, very strong performance for that fund. As we've moved into 2010 and 2011, the attractiveness of corporate bonds has become less so. So as we sit here today, the fund is exposed to perhaps 28-29% of corporate bond exposure, other exposures in government bonds, in securitized products, some emerging market debt. So there's this constant shifting of investment to areas of best value. There's no area that is always going to be an attractive area of investment, because it will change through time.
Yeah, but apparently the risks are concentrated on the government segment, especially in the Eurozone.
At the moment, certainly, yes, that's where the focus of attention
what
is.
is Standish's view on the risk in the Eurozone, and especially Greece, Ireland and Portugal, and probably Spain and Italy? What are Standish's view on this issue?
Well, we have to have a view, because those countries you just mentioned, their bonds represent a very large part of our market. If you just take the countries of Spain, Italy, Ireland and Portugal, collectively their government bonds, their corporate bonds issued out of corporations in those countries, represent close to about 30% of our benchmark that we're running this fund against. So we need to have a view. Through this this crisis that's evolved in the Eurozone over the last, I guess, 18 months, we have variously been overweight some of these countries and government bonds, underweight, really looking for tactical opportunities to move the fund into, for example, Spanish government debt when it's attractively priced versus German government debt. Presently we are running with positions in Italian government debt and Spanish government debt, which are broadly speaking neutral to the benchmark. So at the moment we don't have a strong conviction either way as far as Spain and Italy are concerned. We certainly have avoided Greece, and we're presently avoiding Portugal. We have a neutral allocation to Irish government debt. But this is very much an evolving story. If you look at how markets are pricing these respective country borrowers, then there seem to be, well, there are four elements. There's core Europe, so this is German, French government debt. You then have Italian and Spanish government debt that is trading in a range versus German debt. Irish and Portuguese debt has moved significantly wider in terms of yield, and Greece is just out there. Greece is clearly an area of tremendous concern to the bond markets, and really it's now pivotal as to whether we're going to see a hard restructuring of that, or a soft restructuring, a reprofiling, I think is the term being used, or whether ultimately the EU and one of the agencies of the EU effectively just continue to refinance the Greek debt as it falls due, and you'll see progressively private sector investors, and particularly banks, be repaid and not have to face the potential for facing write-downs. The issue with Greece and the potential knock-on into Portugal and Ireland is really about the European banking system, which has tremendous exposure to debts in these countries. And the concern is not, I think, about whether Greece will be able to service its debts. It's the impact that Greece not being able to service debts has on the banking system.
Okay, let's switch to another area, probably a most attractive area, which is the emerging market bonds. And I know that you have a very interesting view on how to include emerging market bonds in a portfolio and the advantages of including these type of bonds in a portfolio. Can you elaborate a little bit on this?
Well, one of the attractive features of emerging market debt, certainly the sovereign debt, is that the health of these countries is actually far, far stronger than many economies in the developed world. So you have a rather bizarre situation, it would seem, where the market is pricing the risks of Ireland, of Spain, of Italy at higher, more expensive levels than the risk for Brazil, for Mexico, for Russia. So there's been a complete turnaround. But this isn't or shouldn't actually be too much of a surprise, because the proportion share of global GDP now being generated out of the emerging economies is set to overtake that of the developed world in the next couple of years. IMF data, I think, suggests 2013. So these are economies that are growing for all the right reasons. And there are opportunities in the local currency bonds issued by Brazil or Mexico or Malaysia to take Brazilian real risk, to take Mexican peso risk, to take Malaysian ringgit risk, which has delivered over the last several years a very, very attractive returns, both from the coupon, the yield you're getting, but also from the appreciation of many of these currencies against the US dollar. So this is an asset class that in 2008, which was a very poor year for risk assets, at an index level lost only 5%, recovered incredibly strongly in 2009. I think the index posted about 22% returns, another 16% positive return last year. Through to the end of April, we were up about 7.5%. May seen a little bit of a sell down of some of the currencies, but what's driving this is partly currency strength of the emerging economies and very much dollar weakness. We seem to have got to a point in recent weeks where the dollar was perceived as being oversold, so there's been a recovery and also something of a flight to quality trade still. So emerging market local currency debt is an area that we've seen tremendous interest in. We have a fund in the BNY Mellon range, which is close to now $3.8 billion equivalent. It's one of the larger pure local currency debt strategies out there. And it continues to attract investment, because I think investors are looking at opportunities in fixed income markets and regard that area as being one of the more attractive areas to place exposure.
Mm-hmm. Well, Simon, thank you very much for your views on the fixed income segment. And, well, thank you for having joined me today. Thank you.
Run by investment bankers, and Morningstar's tools can help make